Morning, Dan. It's not morning for you, obviously, but how you doing?
I'm well. How are you, mate?
Yeah, we're very good. We were sad not to see you in Bedford, but we're going to see you in Australia in a few months. Looking forward to that. Looking forward to catching up with you guys.
No, you bet. Sounds like I missed a hell of an event, and looking forward to replicating it or trying to down under.
Yes, we'll do that. Everyone's been chasing us. We should have that announced by Friday as well, so that'd be good. That could go out with this. So, how you doing, man? You good? But what's going on?
Yeah, good. It's been a busy start to the year. In fact, it's almost midway through the year, and it's just gone like the blink of an eye. Everything's happening just across work, personal, family, and then just the whole Bitcoin AI space is fascinating.
Yeah, we're seeing that AI stuff grow. I mean, I pinged you the other day. We'll get into that. Let's get into the mining stuff first, because obviously we've just been through a halving, which seems like one of the most crazy halvings ever. Danny nearly won an incredible bet. Danny, what was your bet?
I don't remember which bet. No, I nearly lost the bet with Harry. Is that the one you mean?
Yeah.
So Harry bet that at some point in this halving epoch, so the next 4 years, that fees plus subsidy would be over 50 Bitcoin. And so the first block got to, was it like 47 or something? Maybe 43? Not quite that high, but it was pretty close. Yeah. So I nearly lost the bet in the very first block, but I'm feeling confident again.
How was the halving for you guys?
Yeah, look, it's fine. It's kind of funny, the amount of publicity and media interest, particularly external outside of the Bitcoin community. And it's the way I described it at the time, felt a little bit like the Y2K bug. Everyone's building it up. And everyone's like, oh, how are you going to plan for this event? And it's like, well, we knew that there was a halving 6 years ago when we set up this business. And here's a scoop. There's another one in 4 years and one more after that. So, look, it was one of those things, it's coming. You plan for it. You plan your business around it. We understand the cyclicality of Bitcoin. There's kind of linked to that halving. And, business goes on. And I think we're in a good spot.
What was the reality of the economics of it? In that, some people talk of it as a complete halving of your revenues, but does it actually work out that way?
No, not quite. And the unknown factor is transaction fees, right? And for people in the audience that may not have had this described to them before, the way we think about Bitcoin mining is essentially every 10 minutes, the protocol generates a random number. All these computers around the world use trial and error, brute force to guess that random number. First computer to guess it wins the block. And as part of winning the block as a miner, you get two sources of revenue. First of all, you get to go in and claim the block subsidy, which is the amount of new Bitcoin that is created every 10 minutes. So many, many years ago, this was 50 Bitcoin every 10 minutes. Then it was 25, then it was 12.5, then it was 6.25, and now we're into the 4-year epoch of 3.125. So that's the halving, as it's referred to. But the second source of revenue is transaction fees, as we were talking about earlier. And when we as a miner find that block and we're successful, we get to claim the block subsidy. And then we go into what's called the MEM pool, MEM pool, which is a bucket of all the pending transactions on the network. I.e., if you want to send a Bitcoin to someone else or a fraction thereof, you need to attach a fee to that proposed transaction in order to incentivize a miner, i.e. us, to include that in the block that we stamp on the network. And we've only got a megabyte of block space that we can use. So we go into the MEM pool, we say we'll grab that one, that one, that one, that one. Naturally, we're incentivized as our other miners to choose the transactions that have the highest fee attached to them. And then we collect all those transaction fees, and that is added to our effective revenue for that 10-minute block. So what Danny was mentioning earlier was around post-halving transaction fees skyrocketed. And in fact, there are a couple of quite clever quips on Twitter saying this isn't the halving, this is the tripling, because miner revenues went through the roof for a period of time. Now that it's settled down, clearly revenues are down across the industry, but it's not half down. It's less than that because of transaction fees.
Okay, Danny's just brought up the hash rate index. So we see the spike, but the hash price, it is lower than pre-halving. Yeah, but does in this period does this make it uneconomical for a number of other miners? So do you see a lot of hash rate turn off?
Yeah, exactly. And this is the whole concept of the cost curve for Bitcoin mining. If you can't pay your power bill, you have to switch off. And it's like a gold producer, it's like a copper producer. If you're low down in the cost curve, you can survive volatile markets. The key difference and benefit as a Bitcoin miner when compared to these commodities is you actually get other people's Bitcoin. Because when they close down, there's still a fixed amount of Bitcoin that is released every 10 minutes through a combination of the transaction fees and the block subsidy. If your share of the network goes up, your share of those fees goes up. So you've got this natural production hedge, if you like, in Bitcoin mining, where you actually mine more Bitcoin when high-cost producers have to switch off, which you don't see in traditional commodity industries. And I think sitting here right now, we're seeing that start to flush its way through the network as we see the hash rates volatile. We saw a negative downwards difficulty adjustment recently. And I think we're now starting to see a number of those high-cost miners come under stress. And it does take time for that hash rate to adjust.
And if you compare this halving, say, to the previous halving, was there any notable differences? The thing I noticed from my side, if you forget the transaction fees, just considering like the Bitcoin price, everything seemed a bit more stable. I know we had the high transaction fees, but everything else, people question, look, is the halving priced in? It kind of felt like it was really priced in more so than any previous halving.
Yeah, certainly it's got a lot more mainstream awareness now. Everyone's talking about Bitcoin relative to 4 years ago, the impact of the halving, etc. I mean, the thing is it priced in? Is it not? I'm in the camp that it can't be. When you've got such a fundamental supply shock for an asset that still isn't mainstream in terms of adoption and ownership and access, and we're starting to see that with the ETFs, when you halve the supply across that 10-minute block, and don't expect some sort of reaction thereafter, I really struggle with that concept. I mean, you look at it, right? And let me get the calculator out really quickly. If you go 6.25 Bitcoin per block times 60,000 times 6 blocks in an hour times 24 hours in a day times 365 days a year, you're essentially talking about $20 billion of annualized supply hitting the market. What we saw 4 weeks ago was that 20 billion halved to $10 billion. Now, economics 101, when you've got an asset that's in price equilibrium, demand and supply are basically netting out. I don't understand how you can withdraw $10 billion of supply from a market like that and say, oh, that's priced in and we're not going to see any consequence over the next 3 to 12 months, particularly for an asset class that people are still getting their heads around at a mainstream level.
So you think there's a lag to this then?
It always has. It always has. We've seen this pre-halving rally. Everyone gets really excited. Then flatlines, comes off a little bit. And then we tend to see it 3-6 months later, that supply shock seems to bite. The price starts heading up. And then you get these FOMO rallies where everyone loves buying shiny objects and they pile on in and it feeds on itself. And eventually you hit a blow off top. Now, is this time different? Who knows? But it does feel like the scene is set for some interesting price action, not just because of the halving of Bitcoin, but because of the macro environment. What's happening with rates peaking, what's happening with geopolitical developments around, the yen and the US dollar and the wars, etc. And this narrative is building this undertone around fiat currency. And I think if you ask the average person in finance what fiat meant 4 years ago, most of them look at you blankly. And all of a sudden, the term fiat currency now has meaning and it has an identity. And I think that in itself shows how far we're coming along.
It has an identity because it has a competitor.
And it has a meaning. It's like it was just money before. And I think now people are starting to realize, well, maybe it's not just money. Maybe there's a little bit more to this thing than we originally thought.
So how does it compare halving to halving, the size and nature of the industry as well? How much maturity have you witnessed?
Oh, undoubtedly. I mean, we first got into Bitcoin, I say we, my brother and I, back in 2013. I've told this story before. We bought on the run up to $1,000. It crashed to 500 and we thought, nonsense, silly magic internet money, sold it all. And, we were silly. And you look back at it then, right, and the industry had just kind of migrated out of people mining in their parents' basements and what it has done over the last decade is just phenomenal. But it's one of those things that it just creeps up on you. Like day to day, month to month, when you're living it, you don't really appreciate it. It's not until you look back and you go, gee whiz, like where did all this progress come from in terms of the institutionalization of the sector, the narrative around it, the mainstream awareness, your Fidelities, BlackRocks, etc. An analogy someone once said to me, it's like, remember how we used to use the old Nokias and you could play Snake on them, the old analog phones? It's like we all ended up with smartphones, but when did that happen? Like you don't really remember the tipping point. It just kind of happened, and you woke up one day and you didn't really live it in the moment and recognize the massive change that was happening. But you look back on it and you go like, yeah, that just happened at some point in time. And I get the sense that the whole Bitcoin awareness and education is a little bit similar.
Yeah, just reminds me of a conversation I had with my son the other day. We were watching a film and they had a ghetto blaster on there, and he was asking me what that was. Yeah, I was like, son, in the olden days. But like my kids have never known a time of no internet. I mean, you will. I don't know if Danny does actually, but you will, Dan, like me. You remember when there was no internet?
Yeah, and the dial-up, MSN Messenger. Oh yeah, that was a good old day.
Those AOL discs.
Yeah.
Danny, do you remember no internet?
No, not really. Like when we were kids, we had really shitty internet. It was like dial-up. It didn't work very well. But I don't properly remember not having internet.
See, mine and Dan's day, we used to have to go to people's houses to talk to them.
Crazy.
We had to look stuff up in books. Danny, do you know what a book is? So obviously there's been massive change for you guys at IREN as well. Obviously you've had the rebrand from IRIS Energy to IREN. You've had huge expansion. I mean, just talk to us about the scale of expansion in the last 4 years for you guys.
Yeah, look, we followed a different trajectory, as you know, Pete, to a lot of the other players in the industry, where we looked at the power, we looked at the land, and we built multi-decade data centers. We never subscribed to this shipping container, sea cans, cutting corners, old warehouses. And I say cutting corners, it's not a negative thing in the sense that the market was rewarding people for bringing on hash rate as soon as possible, but when you do things quickly, it comes at the expense of other things, and that's all good. But being a founder business, this is our baby. We founded it. We feel a lot of ownership for it. We thought, how do we build a long-term business? We fundamentally believe in Bitcoin. We fundamentally believe the world is going to continue using a lot of computing power driven by renewables. So let's build a platform longer term that supports that. And I think the key difference for us is we invested years in advance to lock down our growth trajectory, where we've got over 3,000 megawatts of power and land secured. And every cycle, people wake up and go, I need another 50 megawatts. I need another 100 megawatts. And we knew this was going to be the choke point. Our whole background's infrastructure, renewable energy development. We understand that it takes 3, 4, 5, 6, 7 years from idea to execution on doing these large-scale projects. So it doesn't cost a huge amount of money. Yes, it's a lot of work, but let's go and tie it all up now. And as a result, we're seeing the dividends in the sense that we were the fastest growing miner listed last year. I believe we're now on track to be the fastest growing miner this year, going from 5 exahash to 30 in the next 7 months. And then we've now railroaded expansion to 40 in 2025 through the transaction just announced with Bitmain. So 30 exahash in the next 7 months at a indicative cost per Bitcoin of $17,000 a coin. We're just in a fantastic position now, and it's a testament to also the team that's just executed time and time again, and they're just awesome.
Try and contextualize that expansion from 5 exahash to 30 in 7 months. Help people understand that kind of scale, because what we've noticed, Dan, is that there's this growing we've got this kind of growing interest in Bitcoin again. We're kind of pre-full bull market, but we do have new listeners coming in who won't understand what that actually means.
Yeah, what's an exahash? So an exahash is just a unit of computing power, and whatever proportion of computing power you have of the whole network, you get that share of the Bitcoin every 10 minutes that we discussed earlier. So sitting here today, the global network hash rate is around 600 exahash, give or take. So 30 would represent 5% of that. Now, the hash rate might grow, it might stay where it is by the end of this year over the next 7 months. But we'll end up with somewhere around that kind of 5%, which means every 10 minutes we effectively get 5% of all the Bitcoin. So it's a great place to be. And in terms of that growth, it's not 5 exahash from today. We're already up to 10. We said that we'd do that by 30 June. We've done it by mid-May. Again, the guys are just executing faster and better. We brought forward some data center construction estimates. So we're now going to 510 megawatts this year as compared to 460 megawatts, which was the prior guidance. And I think it's just that investment in long lead items, like anticipating all the civils that need to be done, procuring transformers, circuit breakers, all these electrical items that everyone wants. They can take a couple of years, but get them early. Spend a small amount of money, put the work in, and actually map out your project timetable so that you don't hit these choke points where you can have a single component holding a project up for 7 months.
Wow. So talk about the Bitmain deal as well that you just hinted at there.
Yeah, so it was a big one, and fair to say that we're absolutely thrilled with it. It basically gives us that pathway to 40 exahash. So we've now got 40 exahash secured. What we did was we had an existing option for T21 units, and that might not mean much to a lot of people, but they are 19 joules per terahash in terms of the energy efficiency. Lower is better. So we've now amended that to have the option to elect the newer S21 Pros, which are 15 joules per terahash for that option agreement. In addition, we then bought a further 12 exahash of S21 Pros and have an option for another 12 exahash on top of that. So basically it's driving our nameplate efficiency right to the bottom of where is possible in the current market. 40 exahash that's secured. Clearly we've got infrastructure and power and land that can support more than that over the next couple of years, but that gives us a really good runway over the next 12 months to build into.
How much capacity can you have in exahash on your various sites? Because you've got a lot of land and power access.
We do. So depends how you look at it, but we've publicly disclosed that we've got over 3,000 megawatts of power and land. If you installed all S21 Pros and assume no efficiency gains from here, you'd still be getting somewhere between 170 and 190 exahash. We don't need to buy any more sites, no M&A, no mergers. Like, we own the rights to the power, we own the land. It's just a matter of continuing to raise the capital and keep building out our standardized data center design.
Because every time we talk, this capacity that you're targeting just gets bigger and bigger and bigger. I mean, I remember you telling us the target was 10 exahash. I was like, wow, that's massive. And now you're talking about 30, then 40. And is this the kind of business where you've just got to keep competing to get bigger and higher than everyone else?
Oh, yes and no. I mean, when you can mine Bitcoin at $17,000 a coin and it's worth $60,000 today, and you're getting 18-month paybacks on your capital when you buy these chips, like, it just sounds a cracking business. You got all the upside to business to Bitcoin as well. And the reality is, a lot of people would like to do that, but they can't. They can't mobilize the capital. They haven't got the power. They haven't got the land. They haven't got access to the chip. Like, these are all these real world practical constraints to monetizing this digital asset that just trades in an unconstrained way. And we're now seeing that choke point. And we're now seeing Bitcoin miners have to compete with traditional data centers for what power there is left. And all those timeframes are slipping out. The power's becoming more scarce. And mate, yes, the targets always go up, but they're going to continue. Like, we're sitting here mapping out what we're doing in 2028, 2029. Like, that's where our project planning's up to. Like, we're not stopping.
And that's mining Bitcoin at 17,000 with the price at 60,000. But we all are fairly confident that that's going to go higher. We expect 100,000 to get beat at some point, perhaps this year, higher and higher. So it's going to just keep growing. So the economics just get better and better for your business. And as you said, you're probably in a better position to take advantage of that price. Like, my loose experience of Bitcoin mining is when the price starts to rally, people try to get into mining. But by the time they kind of get in, they've almost hit the top.
Yeah.
Whereas you're already ahead of that.
No, and if you look back through the Bitcoin cycles, this is exactly what happens every time. Because every cycle, it gets longer and harder for the real world, i.e. the hash rate, to catch the Bitcoin price. The Bitcoin price will go vertical. It'll go 5x. It'll go 20x, depending on the cycle. Everyone will go, oh, I need to mine Bitcoin. It's so profitable. They'll order their chips. They'll wait, 9, 12, 15 months for the chips to arrive, at which point Bitcoin's down, 60% off the highs. And everyone's like, oh, the hash rate's still climbing. I thought it was meant to go down when the Bitcoin price goes down. It's like, well, you've got to re-anchor back to the fact that Bitcoin is still 3 or 4 times higher than where it was at the end of the last cycle. And it's just this lag effect of people building the hash rate in, making those investment decisions. The price is coming down. But to be honest, if you're mining with large scale access to wholesale power prices, in many markets, it's profitable throughout the cycle. I mean, even in the depths of these bear markets, if you've got power below, 6 or 7 cents, let alone below 5 cents, generally it's very unlikely you'll have to switch off unless you've got really old hardware.
So every time we speak, I end up asking you the same question. But I know, historically, you've never really held any Bitcoin on the balance sheet of the business. Do you think that'll ever change? Do you look at doing that? Because it feels like we're in a very different stage of the market than last time I asked that question. Last time it seemed like a very good move to not hold Bitcoin on the balance sheet, but now over the next 12 months, maybe that's kind of risk has changed.
Yeah, never say never, absolutely. But part of not holding it today has allowed us to reinvest our operating cash flows and minimize dilution to shareholders. And I just really struggle when you've got all these companies continuing to grow their operations and continue to accumulate Bitcoin, where are you an ETF? Are you a Bitcoin miner? Where's your competitive advantage? I just struggle with the concept of people paying me to hold Bitcoin on their behalf. Now, maybe that changes over the future, particularly if we end up with a working capital treasury balance. Then holding cash is something that I don't do personally. And as a business, I'd struggle to run a business that was sitting on cash for extended periods of time. But at the moment, the cash that we've got is hedged. It's matched to the use of that cash in terms of growing the capital base of the business and doing it in a way that minimizes dilution for shareholders and therefore maximizes, I guess, their profitability per share over time.
So just following on from Danny's point then, is by not holding the Bitcoin, that allows you to focus on growing the value of the shares, which itself is a derivative of Bitcoin anyway. So is that essentially the alternative strategy to holding the Bitcoin?
Yeah, exactly. Our belief is that investments in these data centers, the production of operating cash flow, the reinvestment of that operating cash flow is what our core business is, rather than holding an asset on our balance sheet, which we fund through selling more shares into the market that people could otherwise buy themselves. How is that a value add? If people want a Bitcoin exposure, go and buy it. Ideally, put it in cold storage. If you're not comfortable with that, then go and buy an ETF. They charge a lot lower fees than other corporates to hold it on their behalf. And MicroStrategy are a whole nother case where they've got a really interesting business strategy around leveraging capital structure into owning Bitcoin. And there's interesting opportunities like that. I just don't understand how a hybrid business of a data center business and then speculating on a big treasury balance of Bitcoin at this point makes a lot of sense. But future?
Yeah. And has the investor market matured enough to really understand how to value Bitcoin miners? Because if they're valuing on kind of standard balance sheets, they're probably missing what you guys have invested in. One, access to power, the sites you have, the speed at which you can roll out new exahash. Do investors really understand that? Because balance sheet like for like, you're way ahead of a number of your competitors.
Yeah, I think the fundamental thing that has changed now is demonstrating to the world that it's not just about Bitcoin mining. This is a high-performance computing story where Bitcoin mining is a really profitable use case of high-performance computing and high-performance data centers. As a pure play Bitcoin mining business, you understand why a lot of the long-only funds and fundamental funds have issues, right? Because if you open up your financial model and you model this out and try and do a DCF analysis, your model goes to zero unless you assume Bitcoin goes up in price or you can do something else with the assets. It's just a fact. Now, for all of us that mine Bitcoin, we kind of understand, well, Bitcoin is a 1 and 0 technology. It either goes to zero, which I think is probably not going to be the pace now, and most people accept that, or it keeps going up. Like even today at $660,000 a coin, it's less than 10% the market cap of gold, and it's better at being gold than gold is. It's scarcer, more durable, all that good stuff that we know, right? So you kind of sit here and you know, but for a fundamental investor who's going up to investment committees and go, hey guys, I'm going to buy a Bitcoin miner because Bitcoin's going to disrupt gold and we're going to make lots of money. It's hard, right? And even if they wanted to, because they personally believe in it, are they really going to do it in that kind of corporate institutional environment? So I think the key thing that's changed over the last couple of months, which has garnered a lot of institutional interest, is the fact that we've proven that these are data centers. They're not Bitcoin mining centers. They are multifunctional data centers. And we've now proven that by launching our AI cloud service and expanding that over the last few months, where all we did was unplug racks of some ASICs that were used for Bitcoin mining and plugged in NVIDIA GPUs, rigged them all up, provided a VPN to some AI customers, and they're now utilizing those computers in the same data centers for alternate purposes other than mining Bitcoin.
Okay, so we're definitely going to get into the AI stuff. I'm fascinated by it, and this might lead into it. But how scarce is the access to power and the access to sites now? And how much time are you guys spending on even considering more sites?
So I thought we were good for sites, but now all this scarcity and chat's giving me a bit of FOMO. So we're ramping up the development machine again. And I mentioned earlier, like we're looking at 2028, 2029. We've got several gigawatts to work through before then, but like let's lock it down, right? So it's one of those things that why not go and secure more sites when you've got the skill set, you understand how to do it, let's go and lock them up. And it's a very low commitment in terms of shareholder dollars, but a potentially very high payoff, which comes to your question, like what are these things worth? And reality is I've got no idea. I understand what they're worth in terms of a going concern and monetizing them by building data centers, et cetera, et cetera. You look at the average valuation of the big listed Bitcoin miners, they're trading on about $130 million per exahash of operating capacity. We're building them at 30. Market values at 130, and we're unconstrained by power and land. So you keep doing all that all day. So that's one valuation of the scarcity. But the next one is, well, where's the market up to generally where you've got Bitcoin miners, hyperscalers, data centers all saying we need power and land? And what does that create in terms of opportunity? And as we said in our earnings call, like it's really interesting looking at monetization pathways. When you're seeing reports published by the bulge bracket banks like Goldman Sachs, Morgan Stanley, saying that our 3,000 megawatts is potentially worth $15 to $35 billion just in terms of accelerating access to that power and land for data center companies, you obviously look at it pretty closely and start looking at your options. So short answer is I have no idea. Longer answer is there's a lot of people throwing a lot of numbers and ideas at us, all the way from the banks to underlying investors to data center companies, and we've just got to work through it.
Does that mean raising capital has become a little bit easier because of the potential, or have the capital markets themselves improved more recently?
So there's a couple of elements to this. Now that we've got the AI business launched, top co debt, so corporate level financing, is absolutely a discussion point, because all of a sudden, if you're sitting there as a lender, you're not lending against a business that's now a 1 and 0 on Bitcoin. You've got an alternate use. So I, as a lender going to my investment or credit committee, they say, well, what happens when Bitcoin goes to zero? Because they've got a few of those mindsets on the committee, and it's what they need to ask. They say, well, you can use the same data centers to provide an AI cloud service, and these guys are already doing it already. So there's a collateral value. You're also starting to see some mining sites, not data centers, mining sites trade in the secondary market. So again, establishing the secondary market collateral value. So all of a sudden, that lending market looks to be a lot more real than it has been previously, and probably is if you're a pure play Bitcoin mining company. Second element is GPU equipment financing. Like, that's becoming a really interesting segment of the market. Like, AI is sexy. Everyone wants exposure to AI, including credit funds. There's very limited ability to get exposure to it. So you've seen the likes of CoreWeave. They've raised $2.3 billion in GPU financing. You saw Lambda secure $500 million in GPU financing only a couple of weeks ago. So all of a sudden you say, well, you know what? If we bought $500 million of GPUs, that would be probably delivering $200 to $250 million of run rate earnings, and we could set them up in 3 to 6 months, given it's just unplugging computers and rigging up the new ones. So that's interesting. And then the final one is building out conventional data centers, tier 3, buying all the GPUs. It is a massive capital task, but there's a lot of capital in the world. And all of a sudden, when you can start talking about JV type structures where you're bringing an operating platform, a platform that's proven its execution capability, knows what it's doing, most importantly, has the power and land, so we've got the ticket to the party, all of a sudden that is opening up conversations around what could a joint venture structure look like, and who are the players involved, and what level of capital, if any, would we need to contribute to that.
What are the economics of AI computing and in comparison really to Bitcoin as a business? Why do this?
So you've built the data center, you've got an investment decision. Do I buy Bitcoin ASICs or do I buy NVIDIA GPUs? Bitcoin ASICs, they'll pay themselves back 12, 18 months kind of time frame, and the gross profit margin, as I mentioned before, will be at $17,000 of indicative cost per Bitcoin mine. Current price is 60. So what's that? 70-ish% gross margin. Pretty good. AI, through the NVIDIA GPUs. So instead of the ASICs, we go and buy GPUs from NVIDIA, plug them in. That's roughly a 2-year payback. It could be 18 months if you take more risk on shorter term contracts or on demand. It could be longer if you look for a longer term contract, but it kind of oscillates around that 2-year payback. The gross profit margins on that are about 97%. So both are great businesses. And people often ask us and say, oh, are you an AI business or a Bitcoin business? Where do you see yourself in 5 years? And I'm like, well, it's a pretty good problem to have. Like being on the tailwind of two kind of exponential macro trends that we both fundamentally believe in, both being my brother and I.
Yeah, how exponential is this AI thing? Because I've talked about it on the show a lot. We use it more and more and more. We're just even yesterday, Connor and I, you know my son, we're opening up a club shop in Bedford for our football team, which is going to be a cafe. All the designs were done on Midjourney, and if I showed you them now, they look incredible. And that would have cost me a fortune to go to a designer to do. We are launching this some clothing lines for the football club. All these were developed on AI. We've got our own exponential use of AI within our business. How exponential is the demand, and how able has the industry been? How able have the data centers been able to keep up with this kind of demand? Because my assumption is everybody everywhere is just using more and more AI tools.
Look, it certainly feels like it, right? And like, no one has a crystal ball, no one has the answer, no one has this kind of global view into every level of detail around demand and products being iterated. So we're all guessing based on limited data. But to your point, like, you see AI come out earlier this week with all those latest developments. They are innovating at the speed of light. Like, it is just nuts. And when we set this business up 6 years ago, at the time, we referenced movies like The Matrix, Ready Player One, Wreck-It Ralph, all these kind of movies that felt like sci-fi. But our strong conviction and belief at that time was that the world was heading on that trajectory. Whether it was something like that, whether it was something different, this insatiable demand for energy and compute was kind of going to fuel the next wave of how society works and interacts together. And I think 6 years on, it's playing out probably faster than even we expected. And I don't know. At the end of the day, I don't need to know. All I know is that there are various ways to monetize all this power and land. It's really cheap to get the power and land if you've got a long time preference. So lock it all up and then make discrete investment decisions at each point in the cycle based on the information ahead of us. Like right now, investing in Bitcoin mining is a cracker. Investing in AI cloud services is a cracker. Fast forward 3 years, could be anything else. I have no idea. I must say, like, there's been a lot of mainstream narrative around data center scarcity and, you know, AI demands and all that sort of stuff. And I don't know, call me cynical, but you read mainstream media and you take it all with a grain of salt. But it wasn't really until we spent a bit of the time traveling across the States in the last month, talking to various businesses, industry, etc. It's like, hang on, this scarcity seems more than real. There actually could be quite a bit of substance to it. So how that manifests itself for different businesses and different industries is all to play out. But I think you do have this confluence of a lot of people competing for whatever power they can get, Bitcoin miners, data centers, hyperscalers. And for some of these businesses, it's not quite existential, but it's beyond like a gross profit line. It's beyond, I can sell GPU capacity for $2.50 and it costs me 5 cents. It's almost like it's fundamental to how their business transforms itself and their customer base over the next 5 years. Like, you're talking about trillion-dollar companies saying, we really need a gigawatt worth of AI capacity. Zuckerberg came out last week or the week before and said that. And if you've got a $1 trillion company saying we need a gigawatt of power, that is a huge amount. And particularly when you look at their underlying business, it does seem to be the case that there's a bit of an arms race for this power and AI capability.
Did you call him?
I haven't got his number, but I'd love to. Do you?
Danny.
Danny knows everything.
So how does it work? Because with Bitcoin mining, you can essentially just go out there and solo mine yourself, or you can be mined as part of a pool. With AI mine, do you do deals with specific AI companies? Are there brokers you work with? How does that work?
Yeah, there's various different monetization ways. You can sign a long-term contract with an end user. You can sign a long-term contract to provide the GPU compute to like an AWS or a Microsoft or one of these other big companies, and then they offer it as part of their product offering. You can sign short-term contracts with AI scale-ups and startups. You can offer it on demand, which is basically like spot. So you put it on the website all the way through to people clicking a drop-down box and renting some GPU capacity. So at the end of the day, there's various different monetization pathways. We're doing a combo package at the moment. We're just trying everything. So we've got some medium-term contracts with an AI scale-up called Poolside, Poolside. I've gotten used to spelling it because no one understands my accent. They've been great. They really enjoyed the service. They've doubled their capacity, extended the contract, going really well. And then the other portion of our capacity, we're just testing the on-demand market. So let's see how deep this on-demand market is, how big the world is, like individuals, university, small AI startups. What's the level of demand and the market depth like for that kind of computing that's available now? So it's something we're working through at the moment.
Do you think in doing this, you've got some unique insights into the rapid pace of growth with AI? Because, for someone like me and Danny, our exposure will be what we see in the news and the developments of the tools we use, what happens with Midjourney, what happens with ChatGPT, things like Photoshop, adding things. But we don't have I don't have any concept of the scale of demand. But are there price signals that give you an idea of the demand?
Did you see the new GPT on that note?
Yes, it's insane.
The one that's like the movie Her?
The one that talks to you immediately as you talk back and you can interrupt.
It even sounds like the AI from that movie.
Nah,
it's so creepy.
And look, all of that stuff needs these GPUs. And you need a lot of them, right? So when you go on to Midjourney, Pete, it probably takes a minute or so, maybe even 2 minutes to render the image after you put the instructions in, yeah?
It's variable. This is one of the things. So at the time when it was happening, when I first started using it, I didn't realize it was GPU backed. I would do things sometimes, oh, bloody hell, Midjourney's slow today, and I didn't know why. Some days it can be super quick. You can have something render immediately and you get it within 20 seconds. Sometimes it can be 2 minutes. So in my head, I'm like, this has got something to do with their access to GPUs, how they're buying it. And then in my head, I'm trying to figure out, so I wonder what the economics of this is, because I'm paying $72 a month for their best service. How many people are doing that? And are they running at a loss just to get access to that GPU power? And I even had it yesterday for the first time. It says, slow down, you're putting in too many requests. And so I guess they're figuring out their business model, their end as well.
Well,
sorry, load of stuff there.
Yeah, I think you've just learned that the supply can't keep up with the demand. If you're waiting 20 seconds, let alone 2 minutes for this stuff to render, it's indicative of the demand that there is for this service as compared to the supply of GPUs available to provide it.
What about on the supply chain with those GPUs? I mean, is it just NVIDIA producing them? Are there other people? Are they able to keep up with demand?
Yeah, it feels a little bit like the Bitcoin mining dynamic, where you've got your Bitmain as the market leader and you've got a few others kind of playing catch up, I guess, where they're iterating, they're really close. They always seem half a step behind. It does feel the same with NVIDIA, but it's still very early days, and the improvements are coming through both from NVIDIA and the other chip manufacturers. So it's too early to tell. What I always say is we're agnostic. If there's a better computer, if it's faster, if our customers want something different, then we'll just plug it in.
So are they in some ways, are they very similar markets?
The Bitcoin mining ASICs.
Yeah.
There's absolutely parallels and analogs that you can draw around, supply of them is, a oligopoly / monopoly. The price of the chips is basically set at the margins based on what people were willing to pay rather than what the margin on the chip itself is. As I've spoken about this before, where Bitcoin mining, the manufacturers essentially goal seek the price of the chips to deliver the market with their expected return on capital for buying and operating those chips. I think the same is the case with NVIDIA. Whether they're making a 10% margin or an 80% margin, when you've got that scarcity, you've got the key factor of production, you are the price setter, and you can extract all that profitability by setting prices at a level that meet, I guess, the clearing price for the cost of capital in the market.
Interesting. I find the whole thing fascinating. And one of the things I do wonder is I've seen considerably less chatter regarding regulation around data centers for AI as we have seen with it regards to Bitcoin. And I am wondering, is the growth of AI, is that acting like a bit of a protective cloak around Bitcoin?
Yeah, possibly. I mean, I still saw a few articles about that, right? AI is going to boil the oceans. We've moved on from Bitcoin. Look, it's one of those things. I think as people realize that they need something and they want a service, all of a sudden, whether it needs energy or not, it's kind of irrelevant. You just think back 100 years, right, where you got the horse and the cart, and then cars come along and it uses energy and oil. It's like you kind of, society accepts it that you're using energy because you value the end outcome of utilizing that energy. If you don't value the end outcome, then it won't use energy. And when it comes to AI, when it comes to Bitcoin, it's really simple. If you think AI is a waste of energy, if you think Bitcoin is a waste of energy because it has no value, then you have nothing to worry about, because neither of them will ever use energy in the long term because they have no value. Like, it's directly proportionate. So I think as more and more people realize that each of these verticals and each of these use cases has value, the narrative obviously shifts, where they're not criticizing the use of energy as much because they realize it's something they want or they need.
Can we talk a little bit about this Morgan Stanley report? We'll put it into the show notes as well. I found the whole report fascinating. One, that Morgan Stanley is looking at this so closely. And the fact that they're talking about, how do I put this? They're talking about, I know they say crypto mining, but we'll call it what it is. It's Bitcoin mining. they're talking about it like it's just a mature industry, which we know it is. We know the maturity of the industry. I think people outside of Bitcoin who still haven't come in still think of it as just kind of like Wild West online space where a bunch of dudes are getting rich, but they don't understand the maturity behind the industry. But the report itself was just a very mature look at how Bitcoin miners are uniquely positioned to potentially support the growth in AI. And I guess for someone like you operating in the business, talking to investors, having the likes of Morgan Stanley write reports like this must be very helpful.
Oh, look, it is. And Goldman Sachs have done a similar one. And, the people writing these reports are no mugs. Like, we've met with Stephen, who's the lead name on that report. And he's a smart cookie. He's all over it, very well considered. And I think all they're doing is saying, well, these Bitcoin mining companies have got access to a lot of power. Power and land is scarce, as we keep talking about. What's the value of those sites for other use cases? The analogy would be property developers coming into an area where there's a commercial building there at the moment, but it's got a higher and better use. So how do you redevelop it, and what's the value of that to someone looking to redevelop it? And we stepped through the maths with him, we worked through the report, and it's hard to criticize it. Like, it does seem robust, even if it does spit out, quite really large numbers. I really don't know what more to say other than, like, it just gives us more food for thought. We're going to 30 exahash of Bitcoin mining in the next 7 months. That's super exciting. If that was all that we were doing, I'd be pretty stoked. But then we've got the AI cloud service, and we can build that out. We're only capital constrained, and we've got the ability, and we're looking at different GPU financing structures to potentially help us accelerate that. And then you're sitting there on 3,000 megawatts of power with reports and external interest in that. You say, oh my God, like, what do you do with this stuff? So we're drinking from the fire hose at the moment, and there's first world problems, and then there's these problems. But markets change quickly as well, for better or worse. And we just got to keep a lid on it and work through it all methodically and make sure we make good decisions at each point.
One thing that came through consistently in the report was this time to power. Over and over again, they kept mentioning time to power. And the cost structure as that increases, as the time to power increases. Does this come back to the point of scarcity? Is there expectation that time to power will continue to grow as this becomes scarce, or is this something that you guys become aware of and you attack that as a number?
So, funnily enough, time and scarcity go hand in hand. Very few things on the planet are actually scarce. It's more about the time frame you need in order to produce that asset. Apart from time itself and Bitcoin, there probably is no scarcity. We saw an announcement the other day about all this oil having been discovered equivalent to 50 years of production in the North Sea. Like, wait for the next one on gold, right? All these commodities. You can make and build anything with unlimited time. You can build essentially unlimited quantity. So it all is a time game. And interconnections that used to take 3 or 4 years, we're now hearing are taking 6 to 7 years. So it is all about that time game. At the end of the day, we as humanity, we can build out unlimited power. It's just when. We can build out probably 50 gigawatts in a 10-year, 20-year time frame. But when is the need for that power, and what is it worth in the intervening period where you don't have that power? And the report is simplistic in the way it looks at that. It basically says that if you assume an average power price of $101, would someone be willing to pay twice as much for their power to get it sooner? Now, if you're doing AI cloud service, I just spoke about the gross margins, right? We're at 97%. Our power cost is quite a bit cheaper than that. So let's say that $101 a megawatt hour implies a 93% gross margin, 92%, somewhere in that ballpark. All of a sudden, this report implicitly says, well, if someone's willing to accept an 85% gross margin, how much are they willing to pay for each year they can bring forward the power? And then there's a discussion to say it's like only 85%. Well, that's pretty good. Where's the market bid it? Is someone going to accept 80%, 60%, 70%, 60%? So you start doing all these maths. And basically for every year that you're having to wait, you're giving up all this extra profitability. But they don't even focus on the profitability. They're just saying, oh, we're willing to pay a little bit extra for the power. So There's an argument to say the report could be interpreted as conservative in some ways because of that, particularly when you then overlay, all these big strategic considerations around companies needing this power. Like you've got the big tech companies where, we've joked around with different people in the industry where historically power procurement was run by a dude that's procuring staples for the stationery cabinet. Like it just wasn't this big a deal. And all of a sudden it's just been pushed up to board level as key strategic consideration as to how they're going to navigate the next 5 years. So
how challenging is that part of the business, the procurement of power itself?
Yeah, so it's probably worth stepping through. So there's two elements to getting power. One is having access to the pipes. The second one is physically contracting for the electrons in those pipes. So when you apply for a grid connection, this is building the pipes into the network. It's a bit like your water main out the front of your house. You need a pipe that goes into it. Otherwise, you're physically not getting water. You're physically not getting an electron. Now, once that pipe is built and you've got access, how do you actually buy water? How do you buy the electrons? Well, there's a market for that. There's people that trade in power. There's people that trade in water. Generally, it's a regulated utility where you just pay for the amount of power that you can, water or power you consume. The issue is the tap. It's the pipes. It's how you physically connect. And maybe just to give you an insight into what development involves. So if we're sitting here today and Danny says, I want to go and develop a power project or a data center in Queensland, up the road. Said, all right, well, how am I going to do that? I need to find a map of the transmission network. Cool. All right. I need to find someone in the utility that can give me a steer on how much power might be available on different lines within that transmission network. Cool. All right. There might be some power around this area of Queensland. Next, I need to go and door knock on local farmers and say, hey, guys, you reckon you could lend me some land? Maybe I can option it up and give you an option fee. So finally you do that. You then go back to the utility and say, I've got some land and it's adjacent to the power lines. Now can I find out if there's actually power? And they say, yeah, sure. Fill out all this information and we'll kick off a connection study. Pay us this money and we'll see you in 6 to 12 months. All right, sitting there waiting. 6 to 12 months, they come back and that can be a good case. And they say, guess what, Daddy? There's 100 megawatts there. It's going to cost us 3 years to build out the interconnection. It's going to cost you $15 million. Let us know if you're interested. And at that point, you say yes or no, and then you kick off the construction timeframe to do it. And that's just reality. Like it's always been the case, whether you're building renewable energy projects, solar, wind, etc. Like you are dealing with risk-adverse regulated utilities. The incentive structure is such where these guys aren't commercially motivated. Like where's the incentive to accelerate it and risk cutting corners? And even if they don't cut a corner and they accelerate it, all you're doing is creating an attack vector where, hang on, our standard timeframes for this interconnect is 3 years. You did it in 2.5 years and something went wrong. It's like, well, why expose yourself to it if you're just going to a 9-to-5 job in a regulated, often government utility? So that's the issue that the whole industry is facing.
But I know you. My assumption is tell me if I'm wrong here. Have you even looked at developing that area yourself, developing your own power, generating your own power?
We have, but it's a cost of capital thing. Like this is
right.
Probably where I came from, right? The infrastructure funds management business where there's unlimited capital chasing investment in wind farms and solar farms at return levels that frankly often don't make sense. So I'd rather be on the other side of that trade and take the cheap power that they're incentivizing and monetize it into this, AI Bitcoin thematic.
Do you think that unlimited capital will start chasing the sort of mini nuclear reactors?
Yeah, it's amazing. Every cycle you start seeing more and more pitch decks for different ideas. And we got one the other day for mini nuclear in Texas. And I don't know. Let's see where it plays out. A lot of this stuff, most of it doesn't happen. The stuff that does takes a lot longer than you think. Nuclear, I think I struggle with from a business perspective. I have no personal aversion to it, but we've set this business up, as you know, on the basis of targeting excess renewable energy. And if you can locate a mini nuke close to load where mums and dads and other industry can use it, what problem are we solving in going and locating there and taking that power? Compare that to where we are in Texas, for example, where in West Texas, there's around 40 gigawatts of wind and solar. The transmission line capacity, i.e. the pipes to export that load down to Dallas and Houston and the load centers, is 12 gigawatts, 40 into 12. So we can go and locate up in that panhandle region, monetize a lot of that excess renewable energy and actually solve a problem. And this is what we saw when we set this business up 6 years ago. These government incentives in Western countries to build out renewables to satisfy these targets, where it wasn't a great price signal, right? Building out intermittent renewables in markets where there was no price signal. You think about the owners, the infrastructure funds that own the wind farms and the solar farms up in that panhandle region. They're still getting their renewable energy certificates. They're getting their income tax credits at a federal level. The fact that they're having to curtail large amounts of power and spill this power and build it in the middle of the desert where people can't use it, well, that's secondary. They're getting their return and governments are ticking their renewable energy targets. Happy days. What's wrong?
But isn't it ironic that it's a Bitcoin mining company which has been attacked for its green or less than green credentials that's actually come in to make these sites more efficient? I find it just just laughable.
Yeah, it wasn't like particularly 5-6 years ago it was, but I think we're finding, and you've probably seen this as well, the world is becoming more and more skeptical of the narrative. They're realizing that there's never a sole source of truth. There's never a single fact point. Everything's nuanced. Everything's based on where it's coming from. There's agendas, etc. So I think people are now a little bit more open-minded. You've got these really large miners, a few of them that are listed, that are in a good position. They've got access to capital. They're growing. And then you've got the rest of the market, particularly the private market, where it's hard to raise capital. It's hard to keep growing through the cycle. And then even within the listed Bitcoin miners, you're starting to see this dislocation into people that are pursuing AI and other business lines and people that are staying pure to Bitcoin and hodling it. And, there's a lot of emotion on social platforms like X and whatnot. My personal view is it's great. Like, that's what capital markets are for. Like, let the market decide, provide all these different options, different strategies, and just enjoy the ride. Don't get too critical about it all.
Well, listen, look, it's been really impressive to watch from the sidelines. We've had a little bit of insight from the inside of how rapid the growth has been in a very strange year. So, look, congratulations on that. We love working with you. Looking forward to seeing you in October when we come out to Sydney. Well, when I come out to Sydney, and hopefully we'll get you in Bedford in April. Keep going. Where do you want to send people?
You bet. So Dan Roberts 0101 is my Twitter handle. At Iris Energy CO needs to be updated for IREN on Twitter as well. Drop us a note. Try to be active.
Awesome. Right, keep going. Thank you everyone for listening. Thanks, Danny. See you all soon.